Good evening. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure bank statement loans. So, give us just a moment here to go live on all the different platforms. We do have the chat up on the screen there. I see some comments already coming in. Feel free to drop a comment there in the chat as you tune in. And we will get started here in just a moment. Great topic here tonight. Definitely the most popular non-QM loan out there. So definitely something that everybody needs to be familiar with. All right, looks like we are live on all the different platforms. So we'll go ahead and get started. We'll take the chat off the screen for now, but go ahead and keep dropping any comments you have there in the chat. You can drop any questions you have as well that we'll go through after our presentation here. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president Nick Hershey and our chief sales officer Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a in-depth loan officer training topic. Tonight's topic is definitely great because again, we specialize in non-QM loans here, and this is the most popular non-QM loan for primary residences, that is for sure. So I will let Jose go ahead and take it over from here. He has plenty of experience with bank statement loans.
Good afternoon, everybody. Yes, bank statement loan is definitely one of the funnest loan types to do, right? Because this is the one where you can definitely exceed the borrower's expectations. They come to you maybe not knowing what a bank statement loan is. They're self-employed. They're showing you the tax returns, and you're like, oh, Mr. Smith, I don't know, you're only showing $2,000 a month here in income. So let's see your bank statements, and then all of a sudden you review the business bank statements, and you're like, but luckily for you at the Mortgage Calculator, we have all these alternative doc products, and using your business bank statements for the last 12 months, you qualify based on an income of $24,000 a month. So now all of a sudden, the sky's the limit for the house that they want to purchase. So let's get right into how to structure bank statement loans. That's really why the bank statement loans are basically fastest growing segment of origination. They grew definitely post-pandemic. Interest rates shot up. A lot of borrowers that got priced out due to higher interest rates for the properties, but using bank statements, the self-employed borrowers were able to resolve the situation. So what exactly do we mean by a bank statement loan, right? I mean, we're not giving a loan to a bank statement, correct? It is a loan, it is a non-QM loan which uses the borrower's business, personal, or commingled bank statements to calculate the monthly income. You can use either 12 or 24 months bank statements, self-employed borrowers only, and real important to note, with most bank statement loan options, you can combine additional income types with the same borrower or additional borrowers or co-borrowers on the loan, right? So you're going to have the same borrower qualifying with bank statements as the main income, and then add W-2, P&L, asset utilization, or 1099, or even all four if applicable, right? So a lot of options there in non-QM. So don't think this is just for bank statements. This is bank statements plus whatever other income type you can document according to the guidelines. So what are our eligible borrowers and transactions? Well, I mentioned self-employed borrowers. Usually, right, minimum 2 years. There's a 2-year requirement in business, unless there is an exception here. If the borrower has been in business for at least 12 months and previously performed the same job duties as a W-2 employee, like an electrician, a doctor, or a nurse, if we can show that connection, and with a limited employment gap, of course, then pretty sure that we would be able to approve you for that loan if that's your scenario. If you've been at least 12 months self-employed, but you were doing the same job duty or type previously as a W-2 employee. Now we have first mortgage options and second mortgage options. First mortgage options, max for a purchase 90% LTV, cash out refi 85%, rate and term 85. Delayed financing 90%. Delayed financing, that's where you bought a property cash and you're going to refinance it within 6 months after the initial purchase. That's called the delayed financing, and usually that is the borrower qualifies for that under purchase matrix, right? So that's why it's max 90% LTV, because that's the same max LTV for a purchase. And then we have second mortgage options as well, or HE loan and even HELOC options using bank statements to qualify the borrower for income. Those options are max 85% CLTV, meaning between the first mortgage and the second mortgage, max 85% CLTV. So, what are some of our program options? Well, I always like to state this in all non-QM loan types. All program options will have guideline variations specific to that option, right? Each option is an investor that we sell the loans to. They all have different requirements for their loans that they will purchase. That's what we, as the originators, call the guidelines that we have to abide to in order to be able to originate and fund that loan. Now, our program options, you heard me mention this already. We have our business bank statements. Now, business bank statements start with a 50% expense factor, which means if it's 100% total, 50% expense factor, that means you have a 50% profit margin. You can increase the profit margin or decrease the expense factor with a CPA letter. Now, I put CPA because that could be accountant, tax preparer, or actual CPA, depending what information the CPA puts in the business narrative letter, and then can state the business's expense factor. We will then give them the difference as the profit margin on the deposits. In other words, $100,000 a month in deposits. If we deem that it's a 20% expense factor, they're going to get 80% of the deposits, or $80,000 as that month's income. Now, please do know that some program options have expense factor tables based on business type and overhead expectations, right? That's real critical. So usually if it's a 0 employee business, one man show, it's going to have, we have options for 20% expense factor, 80% profit. Then when you go to 0 to 1 employee, that could increase the expense factor, likewise reduce the profit margin. And I do have a sample for you on the last slide. Now, I did mention, and then personal bank statements. Now, personal bank statements, theoretically, you can use 100% of the business deposits. But keep in mind, most personal bank statement options do require at least 2 months of business bank statements to show where the expenses are getting paid from, right? And also to reconcile some of the business bank transfers to the business bank statement. Now, keep in mind, if the borrower does not have a separate business bank statement and all they have is personal bank statement, there's a good probability that the guidelines call to add an expense factor to the personal bank statement, since they only have personal bank statements and do not have business bank statements. So the assumption is that the business expenses are getting paid through the personal bank statement. Hence, that's why you do not get 100% of the deposits when using personal bank statements, unless you can provide separate business bank statements, at least 2 or 3, depending on the guidelines, so that you can show how the expenses are getting paid. If you do have the separate business bank statements and meet the document requirements on what you need to provide there, you can use 100% of the documented business deposits in the personal bank statement. Now, as mentioned previously, you can combine business and personal. That's called commingled statements. When you do commingled statements, the expense factor on the personal statements is going to be the same as the business. They're not going to give you 100% on the deposits in the business, and let's say 50% of the deposits in the business. And so, should I say, you're not going to get 100% in the personal, and unless you have the business. So keep that in mind. That then it would be, excuse me, it would be 50-50, for example, if you had a 50% expense factor in the business, and commingling, it's across the board application of the expense factor. Now, what are some of the potential issues, right? Now, we do have a workaround for this, which I let you know at the end, but the potential issues. Number one, biggest one, cannot document the needed business history, right? The borrower self-files. They don't have any CPA, accountant, tax preparer that can provide the third-party verification letter. I mean, it's hard to figure that's not going to happen, but that does happen every now and then. They don't have a business license, right? Or they're a sole proprietor, and they don't have any corporate docs or articles. Those are all scenarios that have occurred, do occur, that could result in not being able to properly document that the borrower is self-employed. Another potential issue, declining deposit trends. This is actually probably the most popular negative issue, declining deposit trends, right? That's why you're not going to usually use 24 months instead of 12 months, just because 24 months may give you a quarter of a point lower fee. But that means that the look back period is extended by another 12 months. And what if that previous 12 months, the deposits were higher, and now the current 12 months, the deposits are lower? You have a problem. You may not get that loan approved as a bank statement loan. Another potential issue, large deposits that cannot be documented, right? Typically, it could either be large deposits for assets, but here we're talking about large deposits for income, right? Large deposits for income. And a large deposit, by most guidelines, if not all guidelines, will be a deposit that is 50% or greater than the monthly income. So if we calculated our income and it was $20,000 a month average over the last 12 months, then any deposit over $10,000 is going to have to be documented. And what do you mean by that? Okay, you got a $10,000 deposit. Does it say where it came from? Was it a transfer? Was it a transfer from a company? Was it just a counter deposit? Can the borrower provide a contract or an invoice to document it? Can they provide a copy of the actual deposited item that could show who it came from, and maybe a memo of what it actually was? So there's a lot of different ways to document the large deposit to prove that it was income, which is what we're talking about here, not large deposits for assets, but large deposits for income. Another potential issue, irregular deposit trends, right? 1 month, 20,000, don't have anything for 2 months, and another month, 20,000, and then, irregular deposits. So you may have to give a nice narrative of the business model and the business cycle for the operation. That may be normal, right? It may be that those projects pay out every 6 to 9 months. So you got a few projects running, and every now and then they pay out, and you may get a nice big fat paycheck every 2 or 3 months. So perfectly fine if it can be explained. NSFs and overdrafts. Definitely you want to look at this one. Now, I will state that we do have an option that does not consider NSFs and overdrafts that are properly explained, right? If they make sense. But then other options that if it's 3 or more in 12 months, the deal is dead with them. So again, for that, you'd have to really look into the guidelines, see what they state, and if anything, reach out for clarification to who makes that final decision. Is it just a judgment call from the underwriter, or is it just we don't care at all? Right? That's what you got to look at. Also, be very aware of the underwriter increasing the expense ratio due to the business type, right? So you do your calculations based on an 80% profit margin, 20% expense factor, but then underwriter says, wait a minute, look at this business. You're running a retail store, profit margin's not so high, you got more overhead, you got 3 employees, we're going to have to knock you down to 40% expense factor, or 50%, or in some cases 60%, depending on the business type. That is a judgment call by the underwriter when you do have those types of scenarios where they can make that kind of a call when they do have the tables. And I'll show that to you again in the slide. Now, the profit and loss loan, right, is the solution to all these issues like irregular deposits, high expenses, NSFs, and all that kind of stuff. For most P&L loans, you only have to provide 2 or 3 months bank statements to reconcile with the P&L. And in some cases, I think there's a couple options out there that do not require any bank statements to be reconciled, any business bank statements to be reconciled against the profit and loss, right? Strictly the report and the narrative provided by the preparer of the report. So you've heard of all the issues, you've heard of the solutions. Now, calculating the income. Really important, what you should take into consideration here is, again, make note, all guidelines are different, right? I never get tired of saying that. With that being said, once you've identified, at least initially, where you think you're going to submit the loan, right? Normally people go according to the rate, right? But then if there's issues specific to your loan where you may be looking for a specific guideline that has more flexibility in a certain area over another, that's where you're going to need to break it down a little bit better. But initially, you may not have that much information, right? But make sure then that once you have outlined or identified where the loan is going, then review the guidelines and see if they have a bank statement calculation, income calculation service. Most of them now have some type of a service where you upload the statements and usually a business narrative letter. They will review the statements and then they will reply with the completed form and the income. Of utmost importance is to confirm with the investor regarding the income guarantee when using the service, and make sure you double check their calculations, right? Sometimes they do make mistakes. What's pretty cool about this is that if it's an investor that says, hey, whatever they put on that form, unless it's egregiously obvious that it's a mistake, we're going to accept it. And then you have overcome the income hurdle. And remember, on a bank statement loan, never any tax transcripts applicable, right? So don't have to waste time waiting on that. So, but also, you want to complete the form when at all possible yourself. You want to double check the work. So see if the investor has some type of an Excel spreadsheet. We do have generic ones, but see if they may have an Excel spreadsheet that they require so that you don't do double the work. Put the deposits on the generic one and then have to do it again all over again. And typically, how you're going to complete the form, right? And I will show it to you right here. Let me see if I can. I don't think I can make this any bigger, but how you're going to complete the form. Now you'll note, for example, on the upper, thank you guys, on the upper right hand side there, it says CPA expense ratio 35%. If we're using something other than the preset 50% for the table. So you're going to put the expense factor there, and it's going to multiply the total deposits and reduce it by the expense factor to have your total income, right? And then you have a 12-month average or a 24-month average. Now, what's really important is when you do set up the form, you want to go from the most current statement to the oldest statement for your 12 month. And then on the first column that you see there, you want to put the total amount of the deposits, right? So the total amount of the deposits was whatever it says there, $13,365. That's what it is. You put that there. And then in each subsequent column that you see there with a minus, you're going to list individually any deposits that are not applicable business income deposits. So it's going to give you, you're going to have all deposits there, and then all the way on the right hand side will be the net deposit amount. And then the spreadsheet will calculate, add all of these up, give you total deposits, and then number of statements used 12. So then it gives you your 12-month average, 9,480.85. Right. So last but not least, wanted to mention, and you've heard me mention a couple of times about a fixed expense ratio table. Be aware that that can happen, and that's a double-edged sword. I've used it to my advantage when I had a zero employee business where I was able to get the borrower 80% of his deposits because, as you see there from that table, number of full-time employees or contractors, if it's zero, and it's a service business. And this last one I did, I think he did a window treatment installation. So that's definitely service business. I was able to get him 80% of the deposits because it's only a 20% expense factor. But you will notice now, you go to the right, now 1 to 5 employees, now they're hitting us with a 40% expense factor on a service business. And if it's a product business like retail store, you get hit with a 60% expense factor. And if it's 5 or more employees, look at how it keeps dropping. The profit margin keeps dropping because the expense factor keeps increasing. So in this scenario, if you had that 5+ employee borrower, you would not be using this option because, and especially if they had a retail store, because like a convenience store, for example, which is very common, because you'd only be able to give them 20% of the deposits instead of the default 50% on many of the options we have that do not have this table, and simply let you go with the 50% because they figure they make it up on all the ones that probably would have been 80% that they close at 50. That hedges their risk right there. So again, you will know, like for example, in this one where they talk about unacceptable deposits or excluded deposits not limited to the following: cash advances from credit cards, income sources already considered, right? You can't double dip. You can't get your W-2 income if you're going W-2 and then add it also as a bank statement deposit. Non-business related account transfers, like between accounts just to transfer money. Tax refunds, any product returns or credits, gift funds, or any credit line deposits or business financing. In other words, any borrowed money does not count as business deposits. Right? So, and this is just one of the sample guidelines. They're all different. Bring that up to you all. So definitely many opportunities and options here to increase your lending footprint with non-QM and specifically bank statement options. It does make up the majority of non-QM loan origination, like I was mentioning earlier, and you can see why, because what other product can you have a $3,000 taxable income be $30,000 a month for the loan?
Sorry about that. My camera was having issues coming back. Okay, I do not see any questions, so I think we'll go ahead and wrap it up here. Remember that we do this at 7 p.m. Eastern every Tuesday, Wednesday, and Thursday evening with a new topic. So we will be back. We'll see you tomorrow.